Hey friends, Lucian here with the Bullish Bears team. This video is going to be about vertical spreads. So vertical spreads involve the combination of buying as well as writing or selling puts or calls at different strike prices. So when you hear the term writing with options, it's selling. So it's a combination of buying and selling puts and calls at different strike prices. Then each spread has two legs, whereas one leg is a buying of an option and the other leg is the selling or the writing of an option. And this results in the option position, which contains two legs. So the trader is either receiving a credit or a debit. Now, the term vertical spread is basically the overall umbrella for terms such as credit spreads and debit spreads. So when you hear of credit spreads and debit spreads, that falls under the umbrella or the term of vertical spreads. So let's talk about debit spreads. A debit spread is when putting on the trade costs money, and that's where the term debit comes from. So think about using a debit card. When you go to use a debit card somewhere, you pay money, right? So it costs you. So for example, when one option costs, let's say $300, but the trader receives a credit from the other position, the net premium cost is a $200 debit. It costs money. So it's a combination of buying one option and then receiving a credit from another one, and that ends up being a net debit. So let's take a look at a real life example here of Apple. You'll see to the left, those columns, I have two arrows there pointing at $116 and $121. And you'll see at the bottom left, you'll see a combination of buying and selling an options contract. So that combination of buying one and selling the other gives you that credit. So if you look at that order dialog box, you'll see it's buying. So a debit spread is a buying option. So you're buying when you're doing a debit spread. You're selling when you're doing a credit spread. And you'll see when you do a debit spread, it does limit your max profit. It lowers your break-even prices. So it's rather than just buying, let's say, a naked call or a put, you have to be really directionally biased. With a debit spread, you still need to be directionally biased, but it's a little bit less because you're doing that combination of buying and selling an options contract, which lowers your break-even prices. Now, don't get too caught up in the cost of the trade because I took a snapshot of this during live market hours, so it's off by a penny or so. So again, when you do a combination of putting that order in, you'll see that limit order says $1.98 at the bottom, but the dialog box is $1.97. That's because when I took the snapshot of the screen, the price changed really quick. So don't get too caught up in it, but just get an idea of that combination of buying and selling an options contract gives you that cost of the trade. That combination of doing that buying and selling also lowers your break-even prices. So with a debit spread, you still need to be directionally biased, but a little bit less than you would with just buying a naked call or a put. Now, when the situation is reversed from a debit spread and the trader receives a credit of, let's say, $300 for putting on an option trade, and then the other option costs $100, then the two options contracts combine for a net premium or a credit of $200. So when you're doing a credit spread, you're an options seller, not an options buyer. So here's an example of what it looks like to do a credit spread. You'll see at the bottom left, you'll see now there's a combination of selling one options contract at the top and buying one at the bottom. And you'll see that red dialog box, so it shows you're doing a credit spread. The previous screen showed a green dialog box that shows you're buying or doing a debit spread, right? So again, the coloring kind of shows you the difference, but when you look up over to the prices, you'll see I highlighted, again, just different pricing. You can change your legs, right? So you can widen or shorten your legs legs. Again, we explain how to do all this stuff in our options courses, so make sure you take our options courses if you need more help really understanding the breakdowns and the widening of strikes and all of that. But again, for this video, pay attention to you see those two arrows that I highlighted for price. So the combination of the selling and then the buying of the other one, you'll see that ends up being the cost of the trade, 100, and you'll see this one says $181, but you'll see at the bottom of the screen it says $189. Again, don't get caught up too much in the pricing because I took the snapshot during live market hours, so pricing changes very quickly. But just understand the overall concept of debit spreads, you're an options buyer, and credit spreads, you're an options seller. Now you'll also see here on this dialog box or order dialog box, I put max loss there. I wanted to bring your attention to this because you'll see the max loss is capped on this because, you know, when you go and you are just selling naked options by itself, so when you're selling a call or selling a put without doing it in a credit spread, the risk is massive. You can lose a ton of money just selling naked options. So this is where credit spreads come into play, that combination of selling and buying an option. You'll see that the max loss ends up being a lot lower, and that's why credit spreads are a very popular strategy. So again, with debit and credit spreads, with a debit spread, you pay a premium, so just think about using a debit card, you're paying, and with credit spreads, you collect a premium. So let's talk about some of the different terminologies of debit and credit spreads. This is where it can trip up a lot of new traders because there's several names in the trading industry for essentially the same thing. And this is where it can take some time to just kind of let your mind wrap around this, because you'll hear, you know, several terminologies for the same thing and it's the same strategy. And that's where it could be very confusing. So with a debit spread, the most popular is called, you know, let's say a call debit spread. So when you're bullish on a stock, a call debit spread is also known as a bull call. So if you hear the term bull call or call debit, it's the same thing. You also hear other terminologies as well. These are two of the most popular, you know, names. There's typically, when I go through these, you'll see there's two associated with each of these strategies, but there's also some people will call them like, you know, long or short verticals as well. So that's where it just, there's even more names for them, but just kind of hone in on just the terminology of call debit or bull call. That means you're an options buyer, and that's when you are bullish on a stock. So if you hear of call debit or bull call, that's where you're bullish on a stock. If you hear put debit or bear put, you're also an options buyer and you're bearish on the stock. Now, when you go into credit spreads, you'll hear the term call credit spread or bear call. That's where you're an options seller and you would be bearish on the stock. And then when you hear the term put credit or bull put, you're an options seller and then you're bullish on a stock. So you might want to take a screenshot of this and kind of just look it over, because it takes some time to just absorb this, especially if you're new. It takes a while looking at these same terms over and over for it to just kind of just make sense. It's kind of weird how there's just several terminologies for the same thing, but take a screenshot of this, you know, keep it handy and look at it. So, you know, along the road, it kind of just helps you to understand both terminologies. Again, there's people that call it, again, verticals as well, long verticals, short verticals, stuff like that. But just understand that when you hear those terminologies, it's the same thing. Now let's talk about some of the positives and negatives of debit and credit spreads. So some of the positives are they limit your risk. So your break-even prices get lowered, and it also caps your losses. So your losses get capped, but your break-even prices also get lowered. It also requires less capital to enter into a trade. And one of the positives of credit spreads is you don't need to be directionally biased. You still want to get it, you know, ideally correct, but, you know, an option can trade sideways and you can still profit with a credit spread. So with credit spreads, you still want to get your direction right when you're entering the trade so you're not down on the trade right off the bat. But, it could just, as long as it stays away from the strike that you enter into, and expires away from that strike at expiration, then you profit, right? So some of the negatives of, spreads are it limits your gains. So your gains are capped. You can't make, let's say, unlimited gains. But remember, it's important, with options, this is where a lot of new traders will get greedy. They're like, oh man, I just want to buy naked calls and puts because I can make more money because my gains are unlimited. Well, there's a time and a place to do naked options. And yes, you can make more money when buying naked options. But the thing is it's not realistic to think you're just going to make unlimited gains, right? Remember, there's that time value that goes against you as an options buyer. So if you're not taking profits along the way, you could be up one moment and then down the next. So this is where it's important to not get greedy and just get caught up in that unlimited gains, right? So one of the negatives are, again, your gains are capped. But that's also not necessarily a bad thing. So on one hand, it's bad, but on the other, it can help you kind of manage your risk better and get more focused when trading. Another negative is margin. It's not a bad thing. It's just you can't trade in a cash account, so you need margin, and obviously your broker requires more margin to enter into a spread trade. So if you have a smaller account, those margins on each trade can kind of eat up a lot, or kind of hold some of that money in your account, thus not enabling you to place as many trades. So the bigger your account, the less margin affects you. But if you have a smaller account and you trade on margin, you might not be able to enter into as many trades. Now, with debit spreads, one of the negatives is that you have to be more directionally biased. So with credit spreads, you're less directionally biased. Debit spreads, you have to be more directionally biased, a little bit less than doing negative, or a little bit less than doing naked calls and puts, but you have to still get your direction correct. So again, it's important to remember the term vertical spreads is basically the umbrella of spreads. So spreads fall under that umbrella of vertical spreads. And this video, again, was specifically on debit and credit spreads, which are two of the most popular. There are also iron condors and other strategies, which, again, we teach you in our options courses. So if you need more help on options and the different strategies and how to trade them, make sure you take our options courses.